Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to the fifth chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act of 2017. This chapter will cover charitable contributions. If you will be itemizing your deductions this year on Schedule A, the charitable contribution deduction is claimed in the section entitled Gift to Charity. If you do not itemize your deductions, but you are 70 and a half or older, there is some special information I will share later in this video. There are two items in the Tax Cuts and Jobs Act that affect charitable contributions. The first is the deduction limit was increased from 50% of your adjusted gross income to 60%. What this means is that the maximum amount of charitable contributions that you can deduct is 60% of your income. I know that sounds like a large percentage of income. However, if you are retired with lower incomes but have money in the bank that you want to maintain your levels of contributions, this may come into play. Good news is that any unused contributions due to the limit can be carried over to the following year. Second item concerns contributions to organizations such as a college or university when the gift entitles you to purchase tickets to athletic events at the university stadium. In the past, you were able to deduct 80% of the contribution. However, the new law has repealed this deduction. Therefore, it is no longer deductible at all. We will talk in more detail about this later. Since these two items are the only items from the new tax law concerning charitable contributions, let's review some of the basic rules. Charitable contributions are contributions made to organizations whose primary function is religious, charitable, educational, scientific, literary, or prevents cruelty to children or animals. There are many organizations that we contribute to. If you are not sure if your contributions are going to an eligible organization, there is a website you can check. Go to www.irs.gov/TEOS, which stands for Tax Exempt Organization Search. Amounts you can deduct are cash given, the value of property at the time of the donation, out-of-pocket expenses while doing volunteer work, and mileage at 14 cents per mile for driving to and from volunteer work, plus parking and tolls. This does not include basic travel to and from a charity organization for non-volunteer activities, such as attending church services. Once you add up the contributions given, they need to be reduced by these amounts if applicable. Reduced by benefits received. If you receive any goods or service in exchange for contribution, then you must reduce the deduction by the value of what you received. For example, if you receive a book in exchange for a donation. Reimbursement for out-of-pocket expenses or mileage. We mentioned before that you can include these expenses as a deduction, but naturally you can't deduct them if they were reimbursed. State and local tax credits received. We discussed in a previous chapter of the series that some states enacted a tax credit for contributions to certain organizations. The IRS has ruled that the contribution must be reduced by any tax credit received or expected to be received in association with the contribution. Amount in exchange for the right to purchase tickets. As we mentioned earlier, the deduction has been eliminated if you receive the right to purchase tickets to an athletic event due to the contribution. Most university athletic support organizations have levels that would entitle people for the tickets. If someone contributes above the required contribution to receive the benefit, the taxpayer should be able to claim the amount of contributions above that amount. There are several organizations that we contribute to but do not qualify for a deduction. These are political contributions, gifts to organizations that engage in political activities or lobbying, dues and fees to country clubs, lodges, or fraternal orders, raffle, bingo, or lottery tickets, value of your time or services. I know our time is valuable, but the IRS does not think so. The IRS does not allow you to apply value to your own time. If you pay a third party for help for volunteer service, then this would be considered out-of-pocket expenses and deductible. Value of blood given. Pledges of contributions. You cannot deduct a pledge for a contribution. The property or money must be exchanged to be deductible. And gifts to foreign organizations. To properly claim deductions for charitable contributions, you must maintain the proper documentation. If a single gift is $250 or more, then you must obtain a statement from the organization that covers the gift. The statement needs to contain the amount of the donation or description of the property. If it is personal property, then only a description is required, not the value. Then the statement must indicate if any goods or services were given in return for the gift. If you give multiple gifts to an organization, then you can receive one statement from that organization indicating the total amount of the gifts. If you claim total non-cash contributions in excess of $500, you must complete the Form 8283, which will outline each gift given during the year. Normally one form for each gift date. On this form, you will need to include name, address, and federal ID number of the organization. Therefore, if you are given non-cash contributions, you need to make sure that you get this information from each of the organizations. In addition, you will need to provide the value of the property at the time of the donation and the cost of the property when it was purchased or received by you. This is the minimum information needed. If you contribute large items such as vehicles, securities, or works of art, there is additional information needed. If you give contributions that are less than $250 each, then you need to have copies of canceled checks, credit card statements, or a receipt from the organization with the name, date, and amount of the donation. This limit is per gift. If you give an organization several contributions but each individual contribution is less than $250, then you only need to have this documentation as evidence. For example, if you give to your church $200 a week for the entire year, your total contributions for the year would be $10,400. However, since no individual gift was $250 or more, all you need is your canceled checks as documentation. One rule that remains in the law is the tax-free distribution from an IRA to a charitable organization. If you are 70 and a half or over, the IRS allows you to make a tax-free transfer of up to $100,000 from your IRA directly to a qualified charity. You need to make sure that your administrator of the IRA distributes directly to the organization. The benefit of this is that the distribution from the IRA will not be added to your income. It would not be included on your 1099. Also, you do not have to itemize your deductions to receive the benefit, which may be more of an issue with the new standard deduction amounts. Lastly, this distribution qualifies towards your required minimum distribution. This is a win-win if you have IRAs that require a minimum distribution and you want to make charitable contributions. Discuss this with your tax preparer to make sure that this is done correctly. Thank you for watching this chapter covering charitable contributions. We greatly appreciate your time. Join us next time as we will be covering miscellaneous deductions. See you next time. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.